with Amazon set to report quarterly results. And we've already heard from Alphabet, Microsoft, and of course Meta, all those tech giants and the Fed in focus this week. But what do investors need to watch moving forward? For more on this, we have Alicia Levine, Head of Investment Strategy and Equity Advisory Solutions at BNY Mellon. Alicia, thank you so much for being in studio.
Great to be back.
We appreciate it. Talk to me about what the catalyst is for the market right now, because yesterday was all about these big tech earnings I talked about. Today feels like it's all about the macro. What is the thing driving today's trade?
So we still have like the micro, which are earnings, which are coming in better than expected, and actually historically better than expected overall for the S&P for those who have reported. But also you can't get away from the macro story, right? And the macro story is growth is holding up pretty well, and inflation is sticky on the way down. So we'll hear from the Fed tomorrow. We'll have the labor report on Friday. We had ECI data, did not go in the direction that the Fed wanted. So the macro is still overall determining. I'll say this, given the fact that the data have not been that great and we've just priced out of the market 6 cuts in January and we're barely at 1 cut for the rest of the year, you know, the S&P has held up really well. And so in many ways, I think the market is more resilient than some of the fears out there. And that's because the fundamentals are actually pretty good.
So Alicia, given all that, how have you adjusted your investment forecast, given the fact that inflation remains sticky, the economy, though, has remained remarkably resilient, and then also the equity market has held up maybe better than many people had anticipated?
So we actually moved our expectations for growth this year up about a month and a half ago because it seemed pretty clear that growth was coming in much better than expected. So we're at about a mid-range of about 2% for the year. And we actually moved up our earnings expectations as well because we think a lot of the large cap tech where the margin growth is and where the revenue is and driving earnings going forward. And you can see just from last week, you know, the large cap reporting, earnings were very, very good. So, you know, in the end, you know, the price of the stock market, the price of a stock is, you know, earnings times a multiple. And the earnings are coming in. So even if the multiple has to sit here for a while because yields are moving higher and the market is just a little uncomfortable with the macro story, I think the earnings are coming in to support the market here. I mean, in the end, the market's held up fairly well, even like day after day, with data just not going the way that we'd all like to see it, which is, of course, inflation moving in a linear way down, and it's just not happening.
How long does the earnings picture continue to have that growth? Because there are some other estimates on the street citing this idea that earnings are going to start to stall throughout the rest of the year, and that will give the Fed a reason to cut. Do you disagree with that?
So I disagree. I think it's a story of haves and have-nots. So the way you want to think about this is, look, overall, in the aggregate, the data are really good. The consumer is fine. We have, you know, sub 4% unemployment. We have wage growth. That's kind of the definition of a fairly healthy macro picture. Underneath the surface, if we stay high for longer, and I'm not saying higher for longer on rates because it's high for longer. We don't think the Fed pivots from their pivot. They pivoted in December. We don't think they're pivoting back to a hike.
No hike.
I don't think there's a hike, but they could stay here a long time. And what that's going to do is squeeze those who have to borrow and squeeze small cap companies that have to borrow to grow and squeeze the lower part of the income scale that uses credit to purchase things. So, and anything, if you need a car loan, obviously mortgages, that's where the squeeze is going on. And the longer it stays at 5.25% on rates, you're just going to start seeing this bifurcation where those who don't have to borrow or those who borrowed long and fixed rate, whether it's on the corporate sector or households with mortgages, are going to do better than those who have to borrow short, and that's the problem.
How much of that risk has been priced into the markets, if at all, up until this point?
So I think it's priced into the small cap stocks. I mean, the small caps are still about 25% below their all-time high. They're still, you know, they can't, like, you'll see a few days where small caps will do really well when there's really good inflation data, good meaning lower than expected. And so it's priced into different asset classes in different ways. So the staples aren't doing that great because that tends to be the low-end consumer. Small caps are not doing that well. You know, some people thought this would be the year of the small cap, that they would outperform large cap. It's simply not happening because rates are staying high for longer. And large cap America is more or less immune from having to borrow. And as a result, sub 4% unemployment means you have consumers, you have consumption, and you have revenue and earnings. And so overall, in the aggregate, but there's pain under the surface.
So what trade does that thinking initiate then? What should investors be thinking about for their portfolios if they buy into that exact thesis?
So it seems to be that large cap tech and large cap communications win no matter what. Right, so they win in a thriving, growing economy with lower rates because, in the end, long duration stocks like lower rates, meaning growth stocks. That's when we say long duration. That's what we mean. And they also win in a world that penalizes the small and those who have to borrow because they have moats. They don't have to borrow to grow, and they have massive cash flow. So you want to look for companies that essentially own their future. They don't have to borrow to grow. They have great base businesses. We're hearing from companies all over, actually, not just tech, but other places. Industrials have been great. Certain parts of healthcare have been great, and tech, in a way, wins in both situations. And so that's good. I'd say that if small cap, we think it's still too early to really wade there. That you have to be selective there, and ultimately, rates staying high for longer when the rest of the central banks in the world are cutting means the dollar is going to be strong, and that can be tough on emerging markets.
That's a good point. All right, Alicia Levine, great having you back in studio. Thanks so much for taking the time.
Great to be back.
To
Thank
join us
you.
here, Head of Investment Strategy and Equity Advisory Solutions at BNY Mellon.